These numbers are from the government's funding for lending scheme, and they show the first 3 quarters of 2014. And the light blue one here is the quarterly change in bank lending to SMEs, and the dark blue one is the funding coming from the alternative finance sector. And what's absolutely fascinating here is that if you look in the first quarter of this, the banks are pulling out by an order, as Andrew was pointing out, an order of magnitude more in terms of their lending. They would argue because people didn't want to borrow, but it's an interesting debate in of itself. And the alternative finance segment was a tiny bit of it. For that, shoot forward just 3 quarters then to quarter 3 in 2014. That withdrawal of bank funding was down to minus 128 million. But already alternative finance providers, most of whom are on this platform here, were busily providing twice that level. And I think the message from this really is that actually alternative finance space can absolutely make a difference to funding of small businesses. And so therefore our panel is probably ideally, if I shoot through here, ideally positioned to sort of talk a little bit about this. So let's start actually, I want to start off with Christopher Moore at the UK Bond Network.
Do you just want a bit of an introduction to?
No, let me just talk us through the UK Bond. Now, your solution is to use the giveaways in the title bonds.
Yeah, that's
so
correct.
How do you think that helps the working capital gap?
Well, we look at providing a variety of different sources of use of proceeds. So it's not just necessarily working capital. It can be looking at growth with regards to acquisitions, management buyouts, and so on. But
okay.
I think with regards to the bond structure that we provide, it offers the company a level of flexibility. So we, for example, can provide a company with an overall credit limit, say £2 million, but that ultimately doesn't have to be drawn down in one bond issue. So that could be split across, say, 2 or 3. And I think that's particularly useful from a working capital perspective.
And I'm going along here because actually there's a lot of interesting solutions here around here, and they're all quite different. Dan, I mean, over at Rebuilding Society, you've got a more traditional loan structure, would be the right way of putting it. Yeah. So again, how do you try to fill that working capital gap?
Yeah, this is it, David. Well, growing businesses need access to capital. And my forecast is that actually, post-election, we're likely to see some growth in the economy. Many entrepreneurs are going to be dusting off the business plan that they shelved when the bank said no many years back, and really looking at peer-to-peer and this alternative finance industry as a means for facilitating the growth of their industry. So, whether it's invoice finance or access to loans, I think the sector is set for rapid growth, largely driven through the need in working capital.
Christoph, IROC have got a slightly different model again. I mean, talk us through your model and how you try and fill that gap.
I think we're attacking a part of the market that is particularly underserved currently by other participants. We are focusing on the very long tail. In the UK, there are about 4 to 5 million businesses. The majority of them, obviously, are micro businesses, and it's on that part that finds it particularly difficult to access financing, and are most often classified as consumers by traditional banks. And we saw this as a business opportunity to provide them with the business finance and particularly working capital that they need to run their small business.
And how do you construct it? Is it done by merchant capital? How is it done?
The product that we're offering is a short-term facility for up to 6 months that our customers can draw down from. It is unsecured, which is a very important element, because most of our customers wouldn't be able to provide securities that you would see in asset-backed financing. And I think that sort of makes us stand out. So we require a very, very good technology to understand these fairly complex yet very small customers and understand their trading patterns in order to assess their risk. So compared to other lenders, we put a much stronger focus on technology.
Andy, we've already heard a bit about what you see as the gap. I mean, Assets has done both loans and working capital invoice funding. We saw 2 examples there. What's the mix in your origination flow?
The majority of what we do is probably longer term loans, but we are able, because we have a history of being SME relationship managers, bankers ourselves, we're able to structure something that works for the business. That said, it's not just a straight amortising loan. Sometimes, because there is a project to put a machine into a factory, there's an element of actually getting that machine commissioned. So therefore, we can build in things like interest-only periods that allow them to get that machine commissioned, working, starting to generate more cash that can then pay the loan down. So it's a more structured approach rather than just a traditional straight amortising loan.
And presumably with your new deal with the American company you do, your invoice funding is going to be a bigger bit of what you do.
Yes.
Absolutely.
Yeah, very much so.
Okay. Paul, again, that's what I like. It's an interesting range of kind of peer-to-peer and I suppose alternative business funding and all sorts of different models. Talk me through the Liberus model.
Well, I think the unique part of our
put
model,
it a bit closer.
the unique part of our model is the repayment methodology. So our repayment is totally linked to their revenue or their cash flow per se. So a great example here would be somebody that wants to either invest in their business or take a stock loan at a time when they're not actually going to get the revenues back to fund what would be a traditional loan. So if you take a hotelier in Scotland that wishes to refurbish his bedrooms after Hogmanay, which is absolutely the right time to do that, and the banks might see that as not a good time to make repayments because he might not take his first booking again until Easter. Whereas for us, we accept that there'll be low repayments during that period because they're geared totally to his card revenues. But we'll get higher payments as Easter and bookings come in. So I guess we're quite unique in this, that we're the only people that have the repayments linked directly to their cash flow. So that's a direct response to what customers need today, as well as access to money. It's the right type of money and the right type of repayment that fits their business model.
And just as a side, what would be the average duration to use that concept?
Well, we try and work it over a 6 to 9 month period,
Okay,
but
fine.
Unfortunately I don't have a crystal ball, so I never know when that last payment's going to be. I think what is critical though is that we have to keep that business open. That's our only repayment methodology. So we don't, because we're unsecured, we're not fixed on assets. So it's in our interest to make sure that we make those daily repayments as comfortable as is possible. So it's typically 6 to 9 months.
Angus, again, and finishing off just this kind of interesting panorama of different funding options.
Range, isn't it?
Real range, actually.
And we do it differently again.
Again, so talk us through the Archover model.
Yeah. So what we're providing working capital to companies, usually a fixed term loan for 6 months through to 36 months. Use single repayment at the end of the period, generally. Occasionally it's amortizing, but generally fixed term. Monthly payment of interest. We're allowing the borrower company really to lever on the creditworthiness of their customers. The asset that we're looking to lend against are the accounts receivable. That spreads a little bit into working capital. Into work in progress, where that's on contracted orders. And we're putting a credit insurance wrapper around those accounts receivable. Because one of the main reasons that borrowing companies don't repay loans is because their customers don't pay them.
Yeah.
If you take that risk away or drastically reduce that risk, so you are reducing the risk for your lenders as well. And so what we've put together in that way, so we also take a first charge. So what we've put together in that way is an equation which we think works very nicely for both borrowers and for lenders.
Okay, let's open up and anybody chip in at this point. One of the issues in the States where there's been quite significant growth in alternative business funding of small businesses is that some of the costs are quite high. What's the average cost? And is cost the only thing that businesses are looking for? You know, because sometimes when you hear in America, I mean, there's some of the platforms. I mean, there was a great article in Bloomberg Business Week about 2 months ago about OnDeck, for instance, very successful company. You know, quite often if you look at the APRs are very high, very successful business, but the APRs are very high. Is cost the critical issue, or is it actually other things like flexibility? Whoever wants to speak first.
Yeah, I mean, I think for us it's the flexibility in our product. Obviously pricing is always a concern, but what we can do is we can balance that out by, for example, if a company is sensitive to the cost, we can build in conversion rights into the underlying equity or perhaps warrants.
Kickers and that kind of stuff.
Yeah, royalties on revenues, things like that. But the issue that a lot of the companies that we're seeing have, they've got their existing banking relationships in place, and often the bank's conflicted in that they don't want to lose that relationship, so often they won't give an answer with regards to a loan or you know, make a decision or actually say no. So by the time they get to us, they're usually quite disillusioned with the process, and we're still not necessarily going to be the fastest or the cheapest form of finance, but what we try and do is manage the expectations in terms of our sensitivities and requirements, as well as pricing and timing. And obviously our interests are very much aligned in that we're not trying to protect an existing relationship. We get paid by delivering the funding.
Anybody else? Is it just costs or is it other things?
No, it's you've got to get the hygiene factors absolutely right, first and foremost. A lot of our customers are referrals, so let's be brutally honest with my model. So they've heard no often, and they don't want to hear no again. So for us, taking them through the process, being absolutely honest and transparent with them is very, very critical. And now, what that means for us really is we have to make sure that they understand the cost of our finance and that we understand that they can afford to repay the finance as well. Otherwise, that's just not a perfect situation whatsoever. But when we do any of our surveys, the critical things that come through are, help me understand as quickly as you can whether or not I'm going to get finance from you. That is absolutely number one.
So speed's really important.
Yeah, because if not, they want to move on.
Yeah,
so I think,
quite.
Rather than collect all the information, underwriting decision no, try and help people through the stages. And if you can say no earlier or yes earlier, then you're duty bound to do that. And we get a 75% return customer rate. They finish the product, and 3/4 of our customers will take another product within 3 months. So I'm quite comfortable that we deliver a great value product for people.
I agree. I don't think that cost is an ultimate issue for our customers. Our customers are all entrepreneurs, so they use the funding they get from us to reinvest it in a business opportunity. So the cost is much transformed into an operational cost that flows into the entire cost structure.
Yeah.
And as such,
So it's just an expense, really.
it is an additional expense, and it's an expense that helps them to generate a profit, which they wouldn't be able to size otherwise. And therefore, the cost is of course, very important for them to include into their calculations, but it's not a reason why they would not want to have financing.
Andy?
Yeah, I mean, most businesses, small businesses in the UK, return on capital employed is 25% to 100%.
Yeah.
So to pay 9% to 15%, it's not so much the interest rate that they're paying, it's actually having cash available to invest into the business to grow.
Because it's about being allowed to do something, isn't it?
Yeah, the other side to that is we've been in this really low artificial environment of very, very low base rate.
Yeah.
Long-term cost of capital base rate is around 7%.
Yeah.
So actually the alternative finance sector is correcting what has been a very artificial interest rate. And we're moving back more to where traditional finance rates for businesses were. It doesn't seem to be an issue around the cost. It's more about having the access to the capital that allows them to get on and grow their business.
Daniel, I want to ask you just also a bit about origination, because all of this, cost flexibility and everything amounts to nothing if businesses don't even know you're there. Yeah? Because they'll just go, oh, banks aren't there, therefore I'm not going to borrow any money. Kind of a binary thing, yeah? So one of the big challenges, we talked a bit about it this morning, is origination. It sounds like, I imagine investors in the room are probably thinking, oh, well, I might get double-digit returns, so tell me a bit more about it, yeah? But actually, you've got to source the deals. Where do you get, let's be honest, origination, doesn't it really basically mean, and I'm sure you're going to correct me, doesn't it really basically mean working with a finance broker or spending a lot of money on marketing?
Now that's a loaded question if I've ever heard one. It's a combination of the two, isn't it? So getting your cost of customer acquisition absolutely right is key to having a sustainable business. In this industry, we see many VC-backed firms who are prepared to acquire their first, those customers sometimes at a loss, hoping to make it back on the lifetime value of that customer. So for us, the sources of origination, yes, absolutely depend on the commercial finance brokers that are out there that have the relationships with the borrowers. But also, it is very much about spreading the word of mouth with and amongst the entrepreneurs who have now found this more dependable source of finance, who isn't going to withdraw that overdraft facility and send a letter saying you've got 4 weeks to, we're taking this facility back. And crowdfunding and peer-to-peer lending is spreading really quickly. It is growing. We're working hard on a viral model, essentially. So there's a good referral scheme for the borrowers to be able to
kind of
refer
affinity, like almost, affinity of viral, yeah.
Yeah, this is it. And that's working really well for us.
Angus, what about you? It does come down to, you can spend a few million on advertising. Are you going to ring up your friendly finance broker?
I wish. Which few million is it going to be? We spend a lot of time on PR. Talking to people, a lot of shoe leather, again, just getting out there, talking to people. We've worked very closely with the British Chambers of Commerce to go out. We did a seminar, for example, in Norfolk, in Norwich, a couple of weeks ago. And the word is getting out there about peer-to-peer lending, about crowdfunding generally, but it's still an educative process. I mean, we had 50 people in the room in Norwich, say 10 days ago, and possibly 75–80% of those people, they'd heard about crowdfunding.
Yeah.
They didn't really know what it was.
That's the
and
issue.
where and you know, these are people who, one or two were brokers, if you like, but the majority were company directors whose companies needed to do something, and to do that something they needed some money, and they thought crowdfunding might help them, but they didn't know how or why.
So how are you going to crack it though? You know, because the thing is,
Well, we keep talking to people.
Yeah.
That's what we
shoe
do.
leather.
And that's the shoe leather, and we just keep at it. I don't think big marketing campaigns would actually do it, quite honestly.
Paul, what's your take on it?
Well, we've been around 8 years now, so we've done a shit job at marketing, because I think most people in this audience have probably never heard of my company, let alone the product. You know, you can either invest a lot of money giving away some bad loans or advances and then learn quite quickly, or
Yeah.
you can take 6 years to build the model cleverly and then go out with what is a more sustainable product, and then instead of using that wasted cash on advances for advances, you use it for marketing purposes. I think we're looking forward to the government referral scheme. I think that's going to be a critical opportunity for most people in the room. That'll be good.
When do you think that's going to arrive?
I'm not in the best place to answer that question. I'd like to think this year. I mean, there are a lot of people that are working hard at this. I'll name check. You know, ABF and Adam Tavan are working incredibly hard at trying to make sure that, you know, the alternative finance company is in a good place to you know, be the recipient of that. But you know, there's no silver bullet here. So it's careful cost management of your lead generation funds. And I think if you know, if you can cozy up to organisations that have similar values to yourself, and we don't really compete so much with most of the other finance companies. We tend to work alongside. So we're not a replacement vehicle. We work alongside. So, you know, we're happy to jump into bed with most people, and that helps us. That sort of shares the marketing load.
Gustav?
I think the government scheme indeed is a total game changer for the industry. Banks are spending millions and millions in their branches to acquire customers. If we as alternative lenders can get access to them, that will significantly drive down our cost of acquisitions, particularly as the relationship often ends with the banker and wouldn't get even to us, regardless how much we spend on advertising. But I think the general industry is opening up to us as lenders as well. We recently concluded a partnership with Alibaba, for example, to provide trade finance.
No small company.
Through their platform directly, and I think you will see more of these happening in the future, where we as alternative lenders will be better embedded into the normal product proposition of other companies as a natural way of providing working capital financing.
So partnership model, really. So working with partners like Alibaba.
Yeah, exactly. And so I think in the years ahead, I would see generally the cost of customer acquisition fall, and I think that will be passed on to our customers in terms of better pricing.
One quick thing from each of you now. We've heard a bit of it earlier about Gareth did a very good, interesting thing about default through the cycle, and he said it was multiple about using funding circles 1.5 times. When the next recession comes, it will come at some point. You know, night follows day. Do you think that is a realistic estimate still in terms of 1.5 times the level of default? And if you were sitting in front of institutional investors saying what you should expect over a cycle, a whole business cycle, in terms of net returns from your underlying propositions, what would they be? Christopher?
Yeah, I think there'd clearly be a definite impact in that regard. What we try and do to mitigate the risks is, you know, spend weeks and possibly months assessing and evaluating the opportunities before we actually make that credit decision. Our view around, you know, publishing real default rates, we're very transparent, we've had none, but with regards to projected or forecast rates, we have a slightly different view in that we're not necessarily comfortable in the way that the industry provides these forecast rates and the actual substance attached to them. I think there is sometimes a bit of a question mark, and if I was perhaps an inexperienced investor looking into a platform, I'd put a huge amount of my investment decision based on that 1 or 2% forecast default rate. So we take a slightly different stance in that regard.
Dan, very quickly, what's your take on it?
Yeah, absolutely. I mean, It's essentially, the lenders are taking the decision to invest in the businesses and setting the interest rates. On our platform, there is the margin to absorb some amount of the defaults, so it does tend to work out, it does balance up. We've got a 4% default rate on our platform, and we expect that to sustain. We've got 3 years of history there now, and the platform's growing. Our underwriting model's improving all the time, so, but essentially it is the lenders that take the risk.
Christoph, very quickly, what would your default rate be?
In our case, the default rate to our investors is 0 because we as a platform absorb all of the defaults and are still able to pay debt investors in our platform a fairly high return for that, certainly higher than what they would achieve on most other platforms.
Andy, again?
Go back to one of the slides that I had up before. If you look at the stack of default rates, at the highest end of the SME, you're probably into mid-market. That's a B in the investment grades. 2009, they shot up to about 15% default rate. So will defaults increase? Yes. If you mean defaults as in losses, it's what you do with when loans are going bad to prevent them turning into losses. Again, our model's slightly different, that we are secured on assets. There will be losses. We know that. We're not naive enough to say that there won't be a loss. There will be losses along the way. Judge us at the end of the next downturn to see where we are.
Paul?
Well, we've been privately funded since 2007, so in reality, a bit like other speakers have said, our shareholders will take any loss, but our losses have improved over time. That's because we're embracing new technology. Although there's not sophisticated business credit scoring systems out there, they're coming on all the time, and as they come on, that helps define better decision making. And we have, as I said, such a high renewal. The reality is that when you're renewing a customer, you've got history, or rather they have history, and that
really
makes life
minimise the defaults, isn't it?
much easier. Yeah.
Finally, Angus?
Because we take a different approach from the very beginning, we put the credit insurance rep, we take the charge. I wouldn't really expect our default rates to increase with any sort of downturn.
Okay. Cool. Thank you very much, gentlemen. And put your hands together for our guys about working capital.